The future of capital markets is here, and it's called blockchain. But with this exciting new technology comes a crucial question. How can regulators adapt to ensure a fair, transparent, and efficient financial system? Our U.S. capital markets are renowned for their depth, liquidity, and fairness. However, the legacy infrastructure that underpins them is starting to show its age. Intermediaries like clearinghouses and transfer agents add friction and cost, slowing down transactions and increasing expenses. In contrast, blockchain technology offers a faster, cheaper, and more accessible alternative. Wall Street is already embracing blockchain, with tokenized treasury bills and blockchain-based funds gaining traction. Global banks are also experimenting with tokenized collateral and intraday repo. These aren't speculative bets, they're efficiency plays that reduce settlement times, cut counterparty risk, and broaden investor access. The Securities and Exchange Commission, SEC, has taken notice, with SEC Chair Paul Atkins announcing an agency-wide effort to modernize securities markets using blockchain and decentralized finance tools. The question now is how U.S. regulators will navigate this transition. The core challenge is that existing rules were written for a different era. Current securities law assumes a world where every step is intermediated by humans or centralized actors. On-chain systems, however, operate differently. Smart contracts can issue shares, crypto wallets can hold them, and peer-to-peer protocols can execute trades. The policy goals remain the same, but the mechanisms have evolved. Take custody, for example. In traditional finance, qualified custodians like State Street or BNY Mellon safeguard assets in omnibus accounts. On-chain, custody is dictated by cryptographic keys, with the private key holder controlling the asset. This may seem precarious, but programmable smart contracts like vaults can offer stronger protections, including multi-signature approvals and audit trails. Regulators should recognize these as functional equivalents to qualified custodians, adapting their approach to fit the new technology. Similarly, the current securities market structure, governed by Regulation National Market System, assumes the presence of brokers, exchanges, and clearinghouses. In decentralized finance, these forms don't exist. Instead, liquidity pools and automated market makers execute trades directly and instantaneously on-chain. Validators and block builders act as the de facto matching engines, deciding which transactions are included and in what order. If they're performing the same function, regulators should hold them to comparable standards of fairness and non-discrimination, but in a way that makes sense for decentralized systems. Critics worry about manipulation in decentralized markets, and they have a point. The Maximal Extractable Value, MEV, phenomenon allows insiders to front-run or reorder transactions, potentially harming ordinary investors. Instead of banning the technology outright, policymakers could treat MEV like payment for order flow in equities, a structural conflict requiring transparency and guardrails. Industry-led solutions such as batch auctions and encrypted order flow can reduce MEV abuses while preserving efficiency. Regulators should encourage these developments, fostering a fair and resilient market structure. The benefits of getting this right are immense. Tokenized issuance could enable smaller companies to raise capital globally at lower costs. On-chain custody could reduce reliance on centralized intermediaries, giving investors more direct participation and control. Decentralized trading could operate 24/7 with instant settlement, improving liquidity and resilience. Programmable compliance, such as embedding disclosures and transfer restrictions directly into tokens or smart contracts, could lower compliance costs while strengthening investor protection and regulatory oversight. So, what should U.S. regulators do? First, regulate by function, not form. Hold crypto wallets and aggregators to best execution standards, sequencers to fair access rules, and oracles to transparency and integrity requirements. Second, recognize crypto-native safeguards like smart contract vaults and MPC custody, leveraging these technologies to achieve compliance. Third, support public infrastructure like open source relayers and reliable Oracle networks, which are public goods that need oversight and encouragement. Finally, tailor rules for risk, prioritizing higher standards for protocols, handling securities and certain real-world assets, while allowing general-purpose DeFi to innovate under baseline principles. Securities markets have always evolved, and the SEC has a track record of adapting and facilitating modernization. Blockchain is the next chapter in this evolution. The key is to preserve the fairness, transparency, and investor protection that make our capital markets so admired, while crafting a regulatory framework that leverages the unique capabilities of blockchain technology. Only then will the next generation of capital markets preserve America's competitive edge and fulfill blockchain's promise of a more open, efficient, and inclusive financial system.